Let's go straight into the risks, because with Flowers Foods, the bear case is not about a sudden collapse. It's about slow pressure on volumes and margins in a mature, highly competitive category. The biggest risk in 2026 is volume decline and weak category growth. Packaged bread and buns are stable businesses, but they're not fast-growing. When consumers trade down, reduce discretionary purchases, or shift toward fresh bakery and alternative products, it can slowly chip away at unit volumes. And in a low-growth category, even small volume losses matter. Closely connected is private label and pricing pressure. Retailers push store brands hard in basic staples like bread. If consumers become more price-sensitive, private label gains share, and branded companies either accept lower volumes or defend share through promotions, which pressures profitability. Another major risk is input cost volatility, especially wheat and other commodity-related costs, plus packaging and transportation. If costs rise while pricing power weakens, margins can compress quickly. Flowers can pass through some inflation, but not always immediately and not always fully. That leads to margin compression risk more broadly. Promotions, product mix shifts, and labor costs can all squeeze operating margins. In a defensive consumer staples stock, investors expect stability, so any sustained margin erosion can hit both earnings and the valuation multiple. There's also distribution model risk. Flowers uses a large direct store delivery and route network, which can be a competitive advantage, but it adds complexity and cost. Any disruption, cost escalation, or efficiency issues in that network can weigh on results. Finally, customer concentration matters. A few large retailers have strong negotiating power. If a major customer pushes pricing down, shifts shelf space, or demands more promotions, that can impact profitability even if overall demand is stable. Flowers Foods' main risks are slow volume pressure and margin squeeze, driven by private label competition, commodity costs, and a mature category where pricing power is limited. Consumers are gradually shifting away from basic white bread toward products that feel better for you, things like whole grains, higher protein, lower sugar, simpler ingredient labels, and portion control. If Flowers can keep capturing that shift through the right brands and product innovation, it can stabilize volumes and improve pricing power at the same time. And in a mature category, mix is everything. The next opportunity is margin recovery if input costs normalize. Flour, packaging, and transportation costs have been a major swing factor. If costs cool while pricing holds, you get margin expansion without needing strong volume growth. Then there's mix improvement more broadly. Premium products and higher margin segments can lift earnings quality. Even small shifts in mix can meaningfully improve profitability over time. Another key is pricing and promotions discipline. If Flowers avoids aggressive discounting and focuses promotions where they actually drive profitable volume, margins can stay healthier, even with private label competition. And finally, efficiency gains in the distribution and manufacturing network can quietly drive earnings. In a staples business, operational execution is often the difference between stagnant and compounder. Flowers' best upside path is not rapid category growth, it's winning the better-for-you shift, improving product mix, and expanding margins through normalizing costs and operational efficiency. Now let's look at valuation and key metrics, because Flowers Foods is a classic example of a defensive stock that the market still doesn't reward with strong long-term returns. Start with the long-term result. The 10-year annual return is slightly negative, around minus 2.1%. That's not a collapse, but it tells you this hasn't been a strong compounding story. Investors have collected dividends, but the stock price performance has been weak. On valuation, the stock looks relatively inexpensive. APE of 12.1 and EV to EBITDA of 6.9 both suggest the market is pricing FLO as a low-growth staples business with limited upside, basically a stable but not exciting profile. The cash flow multiple supports that too. Price to free cash flow is about 7.2, which is cheap if cash flows hold up, but it also reflects skepticism about growth and margin durability. On the risk side, leverage is worth watching. Net debt to EBITDA at 3.3 times is not extreme, but it's high enough that management needs steady execution. In a higher rate world, leverage reduces flexibility and makes margin stability more important. Profitability is mixed. Gross margin is very strong at nearly 49%, which shows pricing and brand economics at the gross level. But the net income margin is only about 3.8%, meaning a lot of that gross profit gets absorbed by distribution, labor, and operating costs. Finally, ROIC at 5.7% tells you this is a steady business, but not a high-return machine, which explains why the market won't pay a premium multiple. FLO looks cheap on earnings and cash flow, but the valuation only becomes compelling if the company can defend volumes, improve mix, and stabilize margins without relying on heavy promotions. Now let's quickly check analyst sentiment, and it's mixed but mostly neutral. Flowers Foods has one strong buy and one buy, while 4 analysts rated hold. There are no sell ratings, but there is one strong sell, which tells you the street doesn't see this as a clear winner, but also doesn't see it as an obvious short. This usually happens when the stock looks reasonably valued and the business is defensive, but the growth outlook isn't exciting. Bulls focus on stable demand, cash flow, and margin recovery if costs normalize. Bears focus on slow category growth, private label pressure, and a relatively leveraged balance sheet for a low-growth food business. So the hold consensus is basically the market saying, stable company, but limited upside unless execution improves and margins expand. And that's it for today's quick breakdown. If you found this analysis helpful, please hit the like button and subscribe. It really supports the channel and helps more investors find these videos. Just a quick reminder, this video is for educational purposes only and it's not financial advice.